Imagine opening your mailbox one morning and finding a letter from the IRS. At first glance, it looks routine, just another notice among the bills and advertisements. But when you open it, your stomach drops. The letter says, "Your tax return has been selected for review." Suddenly, questions start racing through your mind. Did you make a mistake? Did you claim the wrong deduction? Or was this just random bad luck? Here's the part most people don't realize. IRS audits are almost never random. In fact, every tax return filed in the United States is quietly analyzed, compared, and scored by automated systems that look for patterns. If your return stands out, even if everything you did was technically legal, it can trigger a closer look. And in 2026, those systems are faster, more data-driven, and more aggressive than ever before. What surprises many retirees is that the red flags the IRS looks for aren't always obvious. You don't have to run a large business or earn millions of dollars to attract attention. Sometimes it's something simple, like claiming deductions that don't match your income level, reporting expenses that look unusual, or showing a lifestyle that doesn't quite line up with what appears on your tax return. In the next several minutes, I'm going to break down exactly how the IRS audit system works and the key red flags retirees need to understand in 2026. I'm going to show you the 8 biggest red flags the IRS is watching this year and how to protect yourself from unnecessary scrutiny. I'm Edward, and this is US Green Card Signal. Imagine opening your mailbox one morning and finding a letter from the IRS. At first glance, it looks routine, just another notice among the bills and advertisements. But when you open it, your stomach drops. The letter says, "Your tax return has been selected for review." Suddenly, questions start racing through your mind. Did you make a mistake? Did you claim the wrong deduction? Or was this just random bad luck? Here's the part most people don't realize. IRS audits are almost never random. In fact, every tax return filed in the United States is quietly analyzed, compared, and scored by automated systems that look for patterns. If your return stands out, even if everything you did was technically legal, it can trigger a closer look. And in 2026, those systems are faster, more data-driven, and more aggressive than ever before. What surprises many retirees is that the red flags the IRS looks for aren't always obvious. You don't have to run a large business or earn millions of dollars to attract attention. Sometimes it's something simple like claiming deductions that don't match your income level, reporting expenses that look unusual for your situation, or showing a lifestyle that doesn't quite line up with what appears on your tax return. The IRS doesn't start by asking whether someone broke the law. Instead, their system asks a different question. Does this return look statistically different from others in the same category? If the answer is yes, the audit risk goes up. And for many retirees today, especially those with rental income, consulting work, side businesses, or complex deductions, those differences can happen more easily than people expect. In fact, many of the biggest red flags the IRS tracks today come from perfectly normal financial decisions retirees make. Downsizing a home, managing a short-term rental, writing off part of your house as a workspace, or deducting business travel after retirement can all trigger scrutiny if the numbers don't make sense on paper. And here's the tricky part. The IRS computers compare your return to thousands of other taxpayers with similar income levels, professions, and even geographic locations. So, if your deductions are unusually high, your expenses look inconsistent, or your financial picture doesn't match typical patterns, the system flags it. That doesn't automatically mean you've done anything wrong, but it does mean your return may move closer to the top of the review list. And this year, retirees are facing an environment that's a little different from the past. Over the last few years, the IRS has invested heavily in new technology, upgraded data analysis tools, and expanded enforcement programs. That means tax returns are now being evaluated with far more precision. What used to slip through unnoticed years ago can now be identified almost instantly by automated systems. For honest taxpayers, that simply means one thing. The details on your return need to make sense. Because if something doesn't line up, income, deductions, business activity, or reported expenses, it can raise questions that lead to an audit. And that's exactly why understanding the IRS red flags for 2026 matters so much. When you know what the system is looking for, you can structure your records, deductions, and reporting in a way that stays compliant while dramatically lowering your risk. The goal isn't to avoid legitimate tax strategies, it's to make sure everything on your return tells a clear, logical story. Because when the numbers make sense and the documentation supports them, the chances of an audit drop significantly. Hi, I'm Edward, and in this video, we're going to break down exactly how the IRS audit system works and the key red flags retirees need to understand in 2026. If you're living on retirement income, managing investments, running a small side business, or even renting out property, knowing how these systems evaluate tax returns can help you avoid costly mistakes. Many retirees assume their taxes are simple once they leave the workforce. But the reality is that retirement often introduces new income streams and deductions that can make tax returns more complex than expected. What we'll do today is walk step by step through the 8 biggest red flags the IRS is watching this year. Some of them involve deductions people claim every single year without realizing they can trigger attention. Others involve situations where your income, expenses, or lifestyle appear inconsistent. But before we get into those red flags, there's one important myth we need to clear up first, because many people still believe IRS audits happen randomly, like drawing a number out of a hat. In reality, the process is far more structured, data-driven, and analytical than most taxpayers realize. To understand why certain tax returns trigger audits, you first have to understand how the IRS actually evaluates them. Because despite what many people think, audits are not chosen randomly. The IRS uses advanced scoring systems that analyze every return after it's filed. These systems compare your numbers with thousands, sometimes millions of other taxpayers who have similar income levels, similar professions, and even similar geographic locations. The goal isn't to immediately accuse someone of wrongdoing. Instead, the system looks for statistical outliers. In other words, returns that simply look different from the typical patterns the IRS expects to see. Think of it like this. Imagine the IRS has data showing that most retirees earning around $70,000 a year tend to report a certain range of deductions, expenses, and financial activity. If your tax return falls within that general range, it blends in with everyone else's. But if your numbers fall far outside those patterns, higher deductions, unusual expenses, or income that doesn't appear to support your lifestyle, that's when the system starts assigning a higher audit score. In recent years, the IRS has also significantly upgraded the way it analyzes taxpayer information. Modern systems don't just look at the numbers you report on your tax return. They cross-reference that information with data from multiple sources. That includes W-2s, 1099 forms, brokerage statements, property records, mortgage filings, and even certain publicly available data tied to assets and transactions. For retirees, this is especially important because retirement income often comes from multiple places at once. Social Security benefits, retirement account withdrawals, pensions, rental income, investment gains, consulting income, and small business earnings can all appear on the same tax return. That brings us to the first major red flag the IRS is watching closely in 2026. The IRS calls this a lifestyle inconsistency, and it happens when the income reported on your tax return doesn't appear to match the lifestyle your financial activity suggests. Let's say a retiree reports $65,000 in total annual income. On paper, that might include Social Security benefits, a modest pension, and maybe some withdrawals from a retirement account. But imagine that same return is connected to property records showing ownership of a very high-value home, vehicle registrations showing luxury cars, and financial data suggesting significantly higher spending levels. When those pieces of information are compared together, the system may start asking an important question. How is this lifestyle being supported by the income reported on the tax return? This is one of the reasons the IRS cross-references tax returns with outside records. Property purchases, real estate ownership, and certain asset transfers are often recorded in public databases. Sometimes, there is a perfectly legitimate explanation. It could be money from an inheritance, proceeds from selling a business, large investment withdrawals, or gifts from family members. But if that explanation isn't clear from the return itself, the discrepancy can trigger a closer look. The key point here is that the IRS isn't trying to measure your lifestyle in a personal sense. They're simply checking whether the financial data associated with your name lines up with the income being reported. The most important step is making sure all sources of income are reported accurately and that major financial transactions are properly documented. And that leads directly to the next red flag the IRS sees more frequently than almost any other. It involves a deduction that is completely legitimate when used properly, but often misunderstood. The home office deduction can provide real tax benefits, but when it's applied aggressively or without meeting the strict rules required, it can quickly move a tax return into the IRS's higher risk category. The home office deduction has become one of the most talked about tax breaks over the past several years, especially as more people began working from home or running consulting businesses after retirement. At the core of the home office deduction are two very specific requirements that must be met. The space must be used regularly for business, and it must be used exclusively for business. That second rule, exclusive use, is where many people unintentionally run into problems. A spare bedroom that doubles as a guest room usually doesn't qualify. A dining table used occasionally for paperwork doesn't qualify either. For retirees who start consulting, freelance work, or small online businesses, it can be tempting to estimate generously when calculating the percentage of the home used for business. Documentation plays a major role here. The safest approach is to keep clear records showing how the office space is measured and used. When it comes to deductions that frequently trigger IRS scrutiny, business vehicle use is near the top of the list. The reason is simple. Vehicles are used for both personal and business purposes in everyday life, and separating those two uses accurately is something many taxpayers struggle to document properly. When a tax return reports 100% business use for a personal vehicle, the IRS often expects detailed documentation to support that claim. If a return is ever examined, the first thing the IRS will ask for is a mileage log. That log should clearly show the date of each trip, the starting and ending mileage where the trip occurred, and the business purpose for the travel. Another major red flag involves businesses that continually report losses without ever showing a profit. If a business reports losses for 3, 4, or 5 consecutive years, the IRS may begin to question whether the activity is truly a business or simply a hobby. Business meals are another area where many taxpayers unintentionally create red flags on their returns. The deduction itself is completely legitimate when used properly. In most situations, business meals are only 50% deductible. The IRS expects these meals to have a clear and documented business purpose. Many retirees have turned to short-term rentals as a way to generate income during retirement. And under the right circumstances, these properties can produce significant tax deductions. The key concept here is something known as material participation. The IRS expects clear evidence that this level of involvement actually occurred. Travel deductions are another area where many taxpayers unintentionally cross into risky territory. The primary purpose of the trip must be business. After going through all 8 of these red flags, you might notice a pattern. The IRS isn't just looking for obvious fraud. In most cases, what they're actually searching for are inconsistencies, situations where the numbers on a tax return don't seem to match the financial story behind them. The most effective audit protection strategy turns out to be surprisingly simple. It's about making sure the information on your tax return is consistent, well documented, and logically connected to your financial activity. There are 4 habits that tend to make the biggest difference for retirees. The first is maintaining clean, organized records. The second habit is separating personal and business finances whenever possible. The third habit involves keeping deductions reasonable and proportional to the income being generated. The fourth habit is making sure your tax return tells a coherent financial story. If you found this breakdown helpful, make sure to subscribe to US Green Card Signal for more videos on retirement finances and tax planning strategies. I'm Edward from US Green Card Signal, and I'll see you in the next video. Stay informed, stay protected.